All right, looks like we're back in and up and running, so sorry about that with the audio problems, but it should be working. If you guys are still having audio problems, please just go ahead and shoot it over there in that question part. But we're basically segueing from some of from some of the fundamental news into the technical analysis of the financial markets. So let's take a look at those trends that I was mentioning. And again, I introduced the idea of trends 2 weeks ago when we were talking about Fibonacci retracements, and it was quite hard to find any retracements in the foreign currency markets. So let's see what's going on in some of these different currency pairs. So I'm going to bring up the pound versus the US dollar. And about 2 weeks ago, we were down here in this congestion area, and then we obviously broke out. So the pound has really strengthened quite a lot against the United States dollar. Let's go ahead and look at the euro. So we'll do it on a daily time frame again, and you can see the euro. So that's a pretty good trend right there. And then, of course, a lot of you are hearing about the commodity pairs. So here's the Australian dollar that is priced out, obviously having a lot to do with gold. And you can see what it's done. It's basically at all-time highs. I'll actually pull it up on a monthly so that you can see it. It hasn't really been higher than where it's at right now. So the Australian dollar is doing very, very well against the United States dollar. Every single day you can see those green bars. So we're going to start to introduce those moving averages in just a moment. All right, so I've talked to you guys about various types of trading, and that's what I do as a consultant is I find out what that person is looking for. Some people trading foreign currencies are looking for day trading opportunities, very short time frames, intraday. Some people are looking for longer term, trying to catch a longer wave. As you can see here, it's a good market to be obviously trading with the trend in and holding on to your trades. And some people even are looking to use the markets as a hedge. And what I mean by hedge is, let's say that your equity portfolio or your mutual funds or whatever you have over on the stock side is heavy, let's say on the commodity side, or maybe you're holding gold, commodities, gold stocks, the actual gold bullion maybe, and you might be looking at the Australian dollar as it run to the upside, and you might say this is a great place to buy some cheap insurance that if the dollar starts to strengthen and correct for some reason, then obviously that might protect the decay that you'll see in your equity position if you're holding on to commodities or gold or something like that. Again, going back to the fundamental news, the Federal Reserve said we are looking to keep our interest rates low, exceptionally low for an extended period, so there may not be a reason for this to change other than technically it may get oversold as far as the dollar goes, and other currencies against it may get overbought. So just keep that in mind, that if you're doing it, you're obviously going against the trend if you're buying the dollar, so you have to put in your risk-reward analysis as far as what you're doing, why you're doing it. If you're not trying to hedge something, then it may not make sense to go ahead and implement that trade. If you're more of a day trader, then obviously we know the old adage, the trend is our friend. All right, so again, like I said, please go ahead and use the chat function if you have any questions. It's basically the question section, so I haven't seen any popped up, but you guys are welcome to go ahead, and I will make sure that I answer them as you guys have them. So like I said, let's go ahead and introduce this concept of moving averages here. So to do that, we go up to the top, and we go over to the Insert button, and then we go down to Indicators, and then we can slide all the way down to Trend. Under Trend, we have a number of different indicators, and right here you have Moving Average. And we click on Moving Average, and we get to select the period. How many bars do we want this data to cover? So a longer-term trader might put in more bars. They might be willing to put in 50 periods of data, and we can go ahead and put that in. We'll color it. All right, so it's dark blue, but basically it's 50 periods of data, so it's going to be much more smooth than the red line. The red line is looking at 20 periods of data. So there's not one moving average that basically is the holy grail. It's you as a trader that you need to be consistent. You can't just use a moving average and say, oh, I had a loser, it doesn't work, and move on to the next indicator. You have to stay consistent. And the point with moving averages is they do work, but again, like I said, you've got to use consistency. And I have a question for you guys. What type of markets do moving averages work best in? Do they work best in trending markets, or do they work best in sideways markets? Well, there's a fact. They worked best for the most part if you use them in the normal way. There's various ways to use a lot of these indicators. So you have to know what your indicator does, how you're using it, how to apply it for your trading scenario. But if you use moving averages for the most part as they're intended to be used, the most popular way, then they work best in a trending market. You can see that once the pair starts to trend in one direction, if you've used the moving average to get in, then you're able to ride it for a very long time. So there's a question. Great question. Thank you very much for answering that. Why is the Australian dollar gaining on the U.S. dollar fundamentally? Out there, you guys who are listening in, do you guys know what the interest rate is on the Australian dollar right now? It's 4.75%. What's the interest rate, the borrowing rate basically, for the United States dollar? 0%, 0 to 0.25%. How much can you get in your checking account for interest? How much can you get in a money market? Not much. So if we have a weak dollar in our Federal Reserve, which they came out today and they said it, you can read it on the FOMC statement, they said we are not worried about inflation right now. They said there's no inflation out there. That's basically what they said. They said, hey, there's some, but it's transitory. But they're not going to do anything about it. Other currencies are starting to raise their interest rates. All right, other Federal Reserve governments. We are not. So it makes sense that the more they start to raise, and if we don't, then there's going to be that disparity. So all currencies are really rallying hard, basically, versus the dollar. So hopefully that answers your question. But that's a great question. That's what I want you guys chiming in with. So going back then to this moving average, again, a moving average basically is working in this trending market. So once a pair crosses above or below a moving average, that's your entry. Your entry is to go in based on which direction it went. Did it cross above it or below it? And until it crosses the other way, you don't really get out. So it's more of almost like a system. You're using the moving average to tell you when to get in and when to get out. And you're going to have losers, there's no doubt about it. But as you can see, when there's a trend, you're going to have a very large winner. You're still in this trade, basically, to the upside. And until the currency turns around and comes back down and crosses this red line, if you're using the 20-period moving average, then that's when you finally get out. But you've had a really long run with it. As I said, do moving averages work well in sideways markets? Well, here's proof. Either way, if you're using the 50-period moving average, the blue line, or the 20-period moving average, the red line, well, when we're just going sideways, you're going to get in and out, in and out, in and out, which is called whipsaw. That's normal for moving averages. If you notice that it's a sideways market, you might use something like support or resistance or MACDs or stochastics, other indicators that I'll bring into play. But moving averages don't work as well when a market is cruising sideways. So you may change your time frame in a sideways market, you may change your strategies, you may change your indicators. All depends on who you are. Someone who says, I only use the moving averages, well, they know. They just say, hey, this stinks. I'm getting in, I'm getting out, I'm getting in, and I'm getting out. Eventually, when something trends due to fundamental reasons like interest rate policies or technical patterns, I'm going to have a much bigger winner. So this winner is obviously really, really offsetting any loser that they had in this period, basically, because your losers are pretty small. You just get whipsawed. You get in, you get out. You get in, you get out. So the moving average really lets you have pretty small losers if you're sticking to it. And then, like I said, eventually when it trends, it all depends. If it stays in a range, well, that moving average won't work as well. So that's what's nice, is to have other things in your toolbox that you can trade. But having a good understanding of the fundamental news out there lets you understand that all currencies out there are really, really running. And just to prove to you those interrelationship markets that I talk about a lot, let's just go into Options Express quickly. And I'm going to bring up GLD, which is the ETF that represents gold. Okay? Check out the ETF of gold. This is a 3-month chart. So gold went from 127, otherwise 1,270 an ounce, all the way up to 150, 1,500 an ounce, and over. We crossed that threshold today, basically. So this ETF doesn't match it perfectly. If we wanted to look at the future, For gold, we could go ahead and go into GC M11. We'll look at M as basically the month, so we're looking at June right here. So we can get the actual future. So here we are, as I mentioned, it went above $1,500. So there you are at 1517, but it was way up there today. So does the Australian dollar look very similar to gold prices? Absolutely. That's what I mean by using intermarket relationships and understanding fundamentals and what they're doing to the technical analysis of the markets. So that picture starts to make a lot more sense when you combine those stories. Let me just check back here and see if there's any questions like that. All right. No, but very good. Thank you very much for whoever entered that in. It's a great point to be able to see the relationships between the markets and bring in fundamentals and technicals. So moving averages, like I said, they're not a holy grail, and there's no guarantees out there, but the bottom line is you can see how they work well in trending markets. I'll show you another intermarket relationship. This is the Canadian dollar. All right. Let's look at it on a daily. So the United States dollar is going down against the Canadian dollar over and over and over. Let me just go ahead and delete this Fibonacci that's down there. That's old news, obviously. So you can see just in August, the dollar was stronger than the Canadian, 106 to the Canadian dollar. Now we're at 95 cents. We've gotten weaker and weaker and weaker. So my question for you who just asked that about Australian dollar, what are prices doing at the gas pump? How much are you paying? Well, we're not even in summer driving season, and some places are seeing for premium close to $5 a gallon. All right, and we haven't even hit the main season yet. So the Canadian currency, basically in their interest rate policy, they've raised it. Has the United States raised our interest rate policy? No, we haven't touched it. And basically, Ben Bernanke said inflation is transitory. I'll read it to you. This is the Federal Reserve statement. A further increase in oil prices, we've seen further increase in oil prices since the committee met in March. Inflation has picked up in recent months, but longer-term inflation expectations have remained stable, and measures of underlying inflation are still subdued. Measures of underlying inflation continue to be somewhat low relative to levels that the committee judges to be consistent over the long run with its dual mandate. Increases in the prices of energy and other commodities have pushed up inflation in recent months, but the committee expects these to be transitory. It will pay close attention to the evolution of inflation and inflation expectations. So they talked about inflation a lot more, like I said, than they did 6 weeks ago, but they're not changing their stance. We have the lowest interest rate policy out there, and that's what's helping to cause inflation. Also, remember, the fundamentals have gotten better. Earnings have gotten better. More people have been hired. People are flying, people are driving, people are going to conferences. Retail spending has been up, durable goods have been up. So people are spending, so that obviously coincides with more demand and a weak dollar. There you go. You have inflation out there. We're seeing it, but obviously the Federal Reserve isn't seeing it. So you kind of have to be sick, I guess, when you're a trader, as far as really, looking at it and kind of being cynical and taking a good laugh at what our Federal Reserve is doing, because we're seeing it. We're seeing inflation in the markets. We're seeing it, obviously, if you go buy milk, if you go buy products, if you go to the gas pumps, but they're saying they don't believe it's going to stay around for long. So according to the Federal Reserve, at some point, we're going to see lower gas prices, I guess, lower milk prices, lower commodity prices, things like that. So you have the Canadian dollar. Let me go ahead and throw that moving average on, since that's the theme tonight. We'll go ahead and on a longer term chart, the more data you have, obviously the longer term you're going to look at. So let's go into the insert button. Let's go to indicators. Let's go to trend. And I'll throw on that 50 period moving average. I'm going to change the color up and make it so you guys can see it. We'll do lime green. All right, so there's your 50 period moving average. All right, so every time the price comes up to it, maybe you use that as a resistance level, because you're using the trend, you're using the fundamental analysis to know which way things are going. So you probably would want to be a seller when it approaches that line, and if it goes through it, like right here, you have a loss basically. You get out, but you sell it again once it crosses through to the downside, and then you try and stick into it, in with it, as obviously as the trend continues. So these are long-term trends. Let me just put this down to a short-term time frame. So this is a 15-minute chart moving from a daily chart. So the 50-period moving average may not work as well for someone who's shorter term. They may be looking for something that's going to mirror their short-term time frame. So let's go ahead and put in the same moving average, but let's go ahead and put it in a different time frame. So I'm going to use a popular 15-period moving average, and we'll change the color. We'll make it red. So red is basically a shorter term time frame. So again, these markets, as you can see, this is the United States dollar versus the Canadian dollar. Is it trending on this time frame here, this 15-period or this 15-minute chart from the 25th of April to the 27th of April? Not so much. Yeah, it definitely is lower than where it started. It's lower here than where it was here, but it had some moves to the upside. It kind of went sideways. So again, as I mentioned, the moving average doesn't work as well in sideways markets. But again, it depends on your time frame, and you may have been just trading for a few minutes, just a few, or, some part of one of these 15-minute bars, and you may have used it there. So if I shrink this down even smaller to a 5-minute chart, and we just see the bulk of today. So remember what was the stock market doing before the Federal Reserve? It was flat. So here's the United States dollar climbing, 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 and then we get closer and closer to that Federal Reserve announcement, and then the stock market rallies, 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 demand, 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 demand. The Federal Reserve is saying we're going to stay weak as far as our interest rate policy, and the Canadian dollar strengthens, 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 strengthens. So you use that fundamental data to maybe use this short-term time frame, and maybe someone was in this trade just from here to here, or here to here. They used it as resistance. So again, you can apply these in different ways. There's no guarantees they work out. That's why we always have trading plans, and we have stops, and we have targets, and we have the right amount of contracts that we're going to do for our trading size. I walked you guys through that last week in the webinar that you can find on YouTube. I talked about make sure you understand what the terms account risk are and trade risk are, so that you're trading the correct number of contracts that you can handle that loss. Whether you say $200 is my limit, $500, $1,000, $2,000, whatever it is, you've got to say, I'm willing to risk 5 pips because of this trading scenario. I'm risking 10 pips because I'm using the moving average in this scenario. I'm risking 20 pips or 30 pips because this is my trading plan in this scenario. Well, then you have to figure out, if you're doing a standard lot and you're only allowed to lose $300 because that's your limit, and you risk 30, you do 30 pips. Well, 30 pips times one standard lot is your $300 right there. You do one contract. If you're willing to lose $600 and you're willing to lose 30 pips, then you could do 2 standard lots. Okay, so you obviously have to start with a trading plan first. What are you doing and why? Where are you getting in there based on the charts? Where are you getting out for a loss based on the charts? Where are you getting out for a target based on the charts? That is account risk and trade risk. I talk about that in my blog, and I talked about that in the webinar 2 weeks ago. All right, I'm just checking in to see if anyone has any other questions, so it doesn't look like anything so far has come in, but please keep them coming. So let me continue on and finish up this interrelationship trading here. So we know on a long-term chart that the dollar is getting hammered against the Canadian. Let me bring you into the equity markets. So again, a lot of you might say, I have a bunch of commodities out there, or I work for an energy company, or I own some energy stocks, or my mutual fund is comprised of a lot of energy companies. And I talked about on my blog, I put a couple energy producers on the blog today. So I'm going to bring up USO. Okay, so United States Oil Fund, tracking oil prices. All right, let's look at it on a longer term. Some of these trend lines and things like that might be out of date, but looks like that one is still in play. So there you go. So which way is oil going at the pump? You know which way it's going. Which way is it going as far as the financial markets going? Here it's going up. Which way is the United States dollar going against the Canadian dollar? Going down. Who exports lots and lots of energy? Canada. They export a lot of energy. So it makes sense. So there's some, toppy action here. Look at the USO. It had a top here, and now it might be double topping. I'm not sure. If we roll back into the United States Canadian, we can see that there's not really been bottoming by any means, but it's not just, cruising every single day, getting lower and lower and lower like the Australian dollar against our dollar. It's had some upticks here and there, but obviously the big move is down. So the trend is your friend. The trend is going down. So again, you can see moving averages working for a longer term time frame, and you can see them working for a shorter term time frame. But again, the best thing that you guys can learn is, if you're going to use moving averages, do some work, read about them. All right, this quick webinar tonight isn't going to teach you how to do them, perfectly. There's lots of different ways to use them and apply them, and you've got to make sure that you're using it correctly. But remember, the main theme is that they work best in trending markets. You just have to apply it to your time frame. How much data do you want to look at? Do you want to use it as support? Do you want to use it as resistance? Do you want to use it when it crosses? A lot of people like to use two moving averages when they cross each other, and that's when they get in. So here's the short-term moving average, the 20-period moving average on the Canadian, and then you have the 50-period moving average. So when the red line crosses the green line to the downside, that's a bearish entry. And until the red line crosses back above, they don't get out. So you had one little cross here, and that's a short entry, and you don't get basically back out of the Canadian dollar yet because we haven't had it cross the other way. So when it does cross up, you'll get out of your short, and that might be your entry to go long. So your exit out of a short position, basically short the dollar, may be the same time that you enter and go long. And again, you kind of use it as a system. Every time the 20 period crosses the 50 period, it's either an entry or an exit or both for you as a trader. Again, this is technical analysis tools. This isn't guaranteeing anything in the future. You still have to have trading plans. You saw that disclaimer on the first slide. It's very, very important that you guys go through it. And I think that got cut off, so I do want to go back to that. So here's that disclaimer that most of you did see. It is very important. You're trading a leveraged product, and the currencies can go forever. It's not like buying a stock and they go out of business and it goes to zero. Currency pairs basically can go a long way, and as you know, that leverage can take you out very, very quickly before it's traveled that far if you're trading too large. So account risk and trade risk, huge, huge points there. Again, that's me. That's my consulting company. That's my email if you have questions. That's my blog where I talk about a lot of the themes and a lot of the concepts that we're going over today. Almost every single day, I'm updating that market action. So we went through fundamental analysis, talking about that, obviously, lots recently. We talked about technical analysis, major trends, some support and resistance. Not much support and resistance out there. We're really talking about major trends today. Live market examples, we're able to cover that. Moving averages, when to use them. We talked about trending markets. Time frames, as you saw, you just have to obviously put the time frame that you're using to make sense with what you're trading, how much data you're looking at, and basically what a perfect time to talk about them, because have you seen the dollar? The dollar's getting crushed. Fundamentally, it's getting crushed because interest rate policy, and technically it's getting crushed because we just are in a major trend. So to review, we reviewed those fundamental events, the macro and micro, some affecting the overall market, some affecting specific pairs. I talked about that economic calendar. It's kind of in the back of our minds. The economic calendar, unemployment data, things like that, CPI, PPI, inflation data, it's taking a back seat. Does the Federal Reserve care about CPI or PPI, consumer price index, or producer price index, which are inflationary items? No, they're saying we don't care. We're saying we don't see inflation right now. So you guys have to readjust what makes sense right now. In 2 months or 5 months or a year, who knows? That stuff may come back in. But right now, it's basically the Fed speak or Ben Bernanke speak or anyone there at the FOMC. They're setting the tone. Technical analysis, we'll go into this a little bit more and how we introduced moving averages. So that's basically the session for today. Like I said, we have a little bit more time, so we will definitely get into some more live examples right now, but I wanted you guys to see those slides and make sure I got that disclaimer out to you. Next webinar, just for you guys, is 2 weeks from today, 9 o'clock Eastern. We'll go through the fundamental analysis, so we'll update that and kind of take it with a grain of salt, as I mentioned, because it may not matter. We'll go into technical analysis, intermarket relationships, which are so much in play right now. And then we'll go into intermarket hedging. So we'll focus a lot more on using these really, really elevated prices or these really, really low dollar prices against currencies to help out our equity portfolio, option portfolio, things like that, mutual funds holdings. So where can you find more data? Well, IBFX, Interbank FX, they do a great job of recording all of this. So I'll send this out to my list of clients. If you guys are interested in getting this quickly, please email me and let me know. You do have my email. But this will be up on the YouTube page in about a week or so. You can also get daily trading edge information, lots of good education information. Then, of course, you have my blog as well. So lots of good ongoing information for you guys to stay in touch on a number of different subjects and themes. All right. So let me just check and see if there's any questions, and then we'll get back in and look at a couple more live examples with currency pairs moving over into the equity markets. All right. So looks like the last question we had, which I talked about, was the Australian dollar gaining on the U.S. dollar. I think we hammered that home. But again, I think that you're able to translate that. Now, go into the economic calendar or Google and find out what is the interest rate, or borrowing rate, overnight lending rate in other countries, like over in the Eurozone region, over in Great Britain, if you're looking at the Swiss franc over there. So look at it and see, what are you getting? Maybe you're better off putting your money into one of those checking accounts, basically, or money market accounts, and getting 4.75% versus a quarter or less than that. So that could change tomorrow, obviously. That's been out there for a long time, that the Australian dollar and other currencies are getting a lot better interest. But yeah, there's nothing wrong with, obviously, calling your broker. A lot of different brokers can do that, calling your bank and being able to put your money, obviously, in it. Or why not just trade it? Why not just understand the relationship and make money off it? So let's get back into the markets there and look at it. So let's stick with, let's go back and revisit the Australian dollar, okay? Again, these are basically all-time highs. So how are we going to play this? Well, some of you may look at this and say, what a trend, and say, I don't feel safe getting in here. I know the trend is up, but I feel like I'm buying the top. A lot of us as traders are taught to not obviously chase things, or if the train has left the station, be careful. So when you're buying at this high, and let me shrink this down, now that you see the big picture that we've gone from basically about parity or so, you can see here 98, 99 cents all the way up to $1.09. So, a 9 or 10 cent move on top of the much bigger move. But let's bring this down to a shorter term time frame. So here's basically your intraday trader. You might be looking at 15-minute bars. So we're just looking at the 23rd of February through current data. Let me update this. All right, through the 27th of April. So about 2.5 days of data. So again, you have to understand when is a good place to get in. So here's your moving average. Is the red line, is the 20-period moving average acting as support? Yes, it has acted as support. Will that guarantee that it acts as support in the future? We all know the answer, and that is no. Past performance is not an indicator of future performance. But if you decided to say, that's my trading plan, then you would wait for it to come back down, touch on the 20-period moving average, the red line, put your stop just below it, put your reward up as it jumps off of it, and you have a good risk-reward trade. Obviously, you're thinking, based on past performance, this is high probability. I have a certain amount of risk, which is less than what I'm going for a reward. I'm going to initiate this trade, again, understanding that there are no guarantees out there, that there's no past performance has to guarantee that this is going to go my way. That's why we trade with the right amount of size, the right amount of contracts for our trading account. And so what you can say is, based on this 20-period moving average, it's moved over a period of, hours or so, 15-minute bars here. It moved from 108.20, let's just say, I'll put on the crosshairs. So if you bought it here, 108.20 roughly, and it moved up to 108.76. It moved about 50 or 60 pips. Then it came back down. It hit the red line, 108.50 to 109.16, 109.20, so another 70 pips or so. So for you to say, I'm going to risk 20 pips to make 50 or 60 pips, that's very realistic. For you to say, I'm going to risk 20 pips and try and pull out 500 pips out of that, well, you don't have the basis for that based on past performance. Again, there's no guarantees, but we can say factually, based on past performance, this has jumped off the moving average 50 to 60 pips. Well, then I'm going to try and gain 30 to 40 to 50 to 60 of those pips, and it makes sense for me to risk 15 to 20 to 30 pips because, again, your trading plan is, I believe it's going to touch the moving average, I believe it's going to use it as support, and I believe it's going to jump off of it. If it bounces below that support level and breaks through it, well, that's an indicator to me that my plan was wrong, and that's why I have my stop in there and I get out for a loss. If we have losses all the time as traders, we're supposed to have losses, and we take it. Again, there's no guarantees out there. So this 20-period moving average, look at this area where it was very sideways, all right? Well, it didn't work as well there, but again, you have small reasonable losses. You get in and you get out with a loss. You get in, we get out with a loss. You don't have large losses in these sideways markets. You might have frequent losses, but they're not going to be huge amounts of pips, basically, compared to a winner which can take off and be a lot more. But we're trading with the trend. So if someone says, hey, I want to buy it when it hits the moving average because fundamentally the Australian dollar is stronger than the US dollar based on interest rate policy. Technically, we're in a trend, and the trend is my friend, so I use that analysis to say that I want to be a buyer versus a seller. That would make more sense. Again, being a seller up here, it's hard to just say, I want to sell it, because what happens when you sell it? It goes down very little, boom, it goes right back up. You sell it here, it goes sideways, down a little bit, boom, right back up. So if you're selling it and basically going long the US dollar versus the Australian dollar, well, you're going against the trend, and you're trying to pick tops, and that can be very deadly as well. So the old adage, the trend is our friend, but we understand what's driving that trend, and that makes us feel a little bit safer. Until the Federal Reserve says we're done and we're going to start raising rates, who knows when that's going to be? Maybe this Australian dollar goes 110, 115, 120, 130, and we're going to have lots of Australians hanging out in our bars and partying, I guess, here, because they're going to love that they can come to the United States for cheap, and they're going to be in Vegas and skiing and in Disneyland and everywhere enjoying America. So good for them, but they're loving life, so I imagine we'll see lots more Aussies over here. So let's see, where else did we draw? Let's go to the pound versus the US dollar. Let me just check in to see if there's any quick questions. All right. So here again, you can see where the Great British Pound versus US dollar consolidated. Not a great place for moving averages. This is a daily chart, so I'll put up a longer term moving average. I'll put it in. I'm going to put in 50, and I'll keep it as green, and then we'll do red for a shorter term time frame. Let's find green. All right. So there it is. There's a 50-period moving average. You got some whipsaws there, but when it was actually trending, you got some better action, and then again, it started trending as of late. Let's put on another one. Let's put on our 20-period moving average. We'll put this in red, so to reflect the data a little more closely, and you'll see lots and lots of whipsaws, lots of entries, entries, and exits, and then eventually you had an entry where you may have stayed in for a little, gotten out, maybe had an entry, got back in, and you're still in it. So again, in sideways markets, you can see that choppy action. Trending it works better. Again, if you're using that crossover, here's the 20, the red line, moving above the 50, the green line, and it hasn't crossed since then. So this was your entry, if you're using a moving average crossover, as it's called, and you haven't had an exit yet, and you got in, let's say, at, if you're using this, you got in roughly around, where does this coincide? 158.92, so let's just round that to 159, and you're still in it at 166, so 700 pips. Not a bad ride. Again, all depends on if you're using this scenario, how long you're going for it. Someone might use this scenario, and they may be more of a shorter-term trader and only be looking for 50, 75, 100 pips, 20 pips, whatever it may be. But it all depends, again, on what you're looking for and how much you're in. But regardless, you can see how moving averages work. So that's a 20-period crossing a 50-period on a longer-term time frame. If I was a shorter-term trader, I'm going to go ahead and delete these and just show you what it looks like. Let's delete these. And we'll put on two shorter-term moving averages for your day trader. Whoops. Let's make sure these get deleted. All right, let's go ahead and enter in our trending indicator. Let's put on a 5-period moving average. I'll keep that as red. And a 9-period moving average. So this might be for someone who's trading for minutes, to a half hour, something much shorter, but just want to show you how it works. Let's go to our indicators, trending, and I'll do this as green. We'll put this as green, and we'll do this as a 9-period moving average. So a 5-period moving average and a 9-period moving average. So same thing, it's your crossover. It happens on a very, very, very quick time frame. We're looking at 15 minutes basically. So there you get your cross. So you might get your cross something like this, and you might get in here let's say, even due to slippage, whatever it may be, you get in here due to a fast market, and you don't get out again until here. And then you have a couple whipsaws as it goes sideways, and then it crosses again. It's very hard to see, but it crosses something like this, around 65.36 or so, and it crosses again, and let's say that's at 5 o'clock GMT time, and then at, let's say, 9 o'clock GMT time, 4 hours later or so, you're basically getting out, and you have a nice ride of almost 100 pips or so, 80 to 90 pips. So again, these moving averages work, but consistency is the theme, understanding trending markets, understanding which way to go, and maybe have a bias because you're understanding the fundamentals a little bit better, understanding that they're not going to work if the markets start to whipsaw, but consistency is the theme. Using the same ones over and over that match your time frame and your goals, they can work. So I kind of equate these, like I said, a little bit to a system where you're using it every single time, getting in and out, and understanding that if a market goes sideways, you're going to have those frequent losers for the most part. They'll be small, small amount of pips, but they'll be frequent in nature. And then eventually when the markets do run, then you have a nice ride. And the idea is when the markets run, your winner in that trending area is much larger than the losses that you took over here. Even though you have frequent losses, this one winner is big enough to take those back. But again, it all depends on what you're using, how fast you are, because if you see it cross and then the markets rally up and you don't get until here, well, obviously you're giving up a lot of profit. So that's what I mean, is having a good idea, understanding the fundamentals, which direction you'd like to be trading. Obviously, if we're using the U.S. dollar, we'd rather be selling the U.S. dollar versus other currencies versus buying the U.S. dollar. If you're obviously always going long the U.S. dollar on these crossovers, well, then you might have losers to scratches, basically, because you're going against the trend, so understanding that. So we'll wrap up here. Let me just check back with any questions. I do appreciate your time. Again, sorry for that audio problem at the very beginning, but thank you guys for sticking back in. I think most of the attendees are here. So appreciate it. I'll look forward to speaking with you in 2 weeks, talking about all of the same stuff, bringing in intermarket hedging, using those equity markets, that you guys are holding, using your IRAs, KIOs, things like that, anything that you guys have out there, and seeing, hey, I could buy these. I could use the dollar as some longer-term protection against some of the things that I own out there. So we'll bring those into a little more detail. You guys know how to get a hold of me via email. Let me just bring that up one more time. So the next webinar there is on the 11th of May at 9 p.m. Eastern, focusing on intermarket hedging. And you have my email right here. So if you do want these webinars a little bit quicker, obviously I can get those out to you. But as far as going on the Interbank FX website, once they go through the compliance area, then they'll be put up there. And usually there's about a week or 8 days of delay. So appreciate your time. Have a great couple of weeks, and look forward to writing some more great commentary on the blog and you guys being able to get a hold of that. Have a good night.